What's going on, everybody? Welcome back to Wealth Webinar. And as most of you know, some of you may not, but this is the third week of a 4-week series that we are doing all about, that's right, your house. The hidden equity locked in your walls. Because we started this whole thing with a podcast that said, house rich, cash poor. And that really, it went viral. So we did a 4-week series all about the all-in-one, how to use it. And now we are on week 3. This is where the rubber meets the road. Matter of fact, this is last week. If last week when they did it, it was about access, this week is about acceleration. That's what we're going to talk about. We're going to accelerate your wealth. We're going to accelerate your debt payment. We're going to accelerate anything you are doing, and we're going to do it without working harder, longer, or taking on any additional risk. We're going to do it with the equity locked in your walls. Now, real quick, just to take a step back, most all of you know that in the prior webinars, we were talking about home equity lines of credit, right? But we were talking about an all-in-one. So real quick, let me ask every single one of you, how do you use a home equity line of credit? That's just one of the things I want to know, because I think once we understand how folks are using it, we then can kind of come back around and figure out the proper way to use it and whether or not it's being used properly. The other thing I also want to know is I want to know if any of you have equity in your home and you don't have a home equity line. That's just hidden equity locked in your walls. It's just the equity that you brag about, talk to your friends. And then the other thing I want to know is, we do this webinar every single week, and we've been doing this webinar every week for years and years and years. I can't wait till we can say we've been doing this for a decade, but we're not quite there. But it's been many years. We've never missed one. And we do this without asking you for anything. You'll notice no one on here had to pay anything, but you actually paid the ultimate price to be here. That price is you gave us your time. And I want to give you all the respect and the gratitude for that, because time is the most valuable resource you have. So all of you paid more than anything else because you're paying with your time to learn something new, to accelerate your life, to get yourself out of a difficult situation. And that's what we're going to do. This week is all about acceleration. So let me just kind of turn this over and talk a little bit about the folks that I have on here. I've got Mr. Craig Yenny, my partner in the vault, and also runs our oh my God, I just forgot the name of it. Our advanced markets. Thank you. Advanced markets, our advanced services, where he works with lots of our clients on advanced, complicated stuff. Then we've also got Harrison George from CMG, along with Greg from CMG. We got the one and the only Mr. Snaggy coming in from Florida. And all of you probably know HELOC Joe. So that's our all-star cast. I want to open up this before I turn it over, because I really want to frame this up. But then I'm going to turn it over to Harrison and Greg a little bit, just to kind of do a quick recap. Let me kind of open with this line. I love this, and I think all of you will agree. The bank always wins, don't they? Think about that. The bank always wins. How many of you believe that to be a true statement? The bank always wins unless you change the rules. Today, we're going to change the rules. That's what this is all about. We're going to literally give you all an offer today, give you all something that we have been working on for well over 2 years. This will be a first. So very rarely can I say that on these wealth webinars, where I can say, today we're doing a first, because we've pretty much done everything on this webinar. But today we are going to offer all of you something for the very first time, something that will blow your mind away, something so revolutionary that it literally is about to change an entire industry. But to get to that point, you got to stick around for a little bit. So let's get into this. So last week was about access. This week is about acceleration. Last week, we cracked open the box. I think Harrison and Greg and Stephen did a phenomenal job last week teaching you about how the equity in your home is not dead money. How that equity in your home can be extracted, can be used for lots of things. Today, we're literally going to quantify what those things are. So we're going to show you exactly how to use that power of hidden equity in your walls. We're going to use that power to get rid of high interest rate debt. Okay, we're going to use it to show you how to increase your cash flow, how to support your emergency fund. We've all heard that. And you know what? I just looked this up, and Harrison, you probably know this number, but I did a research. I said, how many people have adequate emergency funds? And it was literally under 10% had adequate emergency funds. In other words, the other day, one of our family members gave us a call and said, hey, I'm stranded. My car broke down. She took the car to the dealership or had it towed, and then they came back and said it's a $4,500 bill. Now, for most of you, you're like, oh, well, that sucks, but you'd have the money to pay that $4,500 or maybe a credit card to bail you out. This family member had none of that money. Didn't know how she was going to get to work, didn't know what she was going to do. Literally was speechless because she didn't have $4,500. And you know what? I thought that was kind of a rare consolidated thing, but it isn't. That is actually the majority of Americans don't have enough money in an emergency fund to literally pay for brakes or whatever broke down on their car. That's a fact. But you do. Remember I said earlier, house rich, cash poor. Most Americans right now feel the pinch. They feel the pinch of inflation. They feel the pinch of the economy slowing down, although Wall Street would never, ever let you think that the markets are slowing down and the economy is slowing down. But Main Street certainly will tell the story a lot better than Wall Street will, because on Main Street, yes, things are slower. Talk to restaurant owners. Talk to shop owners. Look at Target. Target stock is getting hammered today because, well, they're just not doing all that well. This is Target, right? How would Target be going down? Well, when things tighten up and slow down and people get cash strapped, well, the old Target isn't the place that everybody wants to go. And that's what we're seeing, folks. That's what we're seeing. But we're going to put some power in your hands. And we're going to show you how there's a lot more money for most of you available. You just got to know how to play the game. You got to know how to use the banking functions in your life and take back control of them. So with that being said, I want to turn this over and segue this over to Mr. Harrison George, not George Harrison, as I mentioned, Harrison George from CMG Mortgage. Harrison, welcome back to the show. And also, I know you got your trusted sidekick, Mr. Greg there from CMG. So tell everybody a little bit about what we're going to go over today and maybe just do a quick recap of what we've gone over the last 2 weeks with the all-in-one mortgage and how people can literally get control of that hidden equity.
Yeah, of course. Thanks again for having us on here, Chris. Really appreciate the opportunity. And hey, how's it going, everybody? So the last couple of weeks, we've kind of walked through how this loan works. And today we're going to kind of go into more of the philosophy, kind of some sort of an acronym that we've developed to help you guys understand really a roadmap on how to move forward with this product. So to give you a little bit of a, let's rewind for a second, let's kind of talk about what a first position line of credit is. And essentially, a first position line of credit, unlike a second position, we can explain the differences on that in a second. It's essentially a home loan that is combined with a checking and savings account, and it completely eliminates a traditional mortgage. So in this first position line of credit, your paychecks land against the balance of your mortgage, and the payment on the property is actually going to be based off of what you owe, and that's calculated on a daily basis. Not like in a 30-year mortgage, which your payment is based off of what you borrow in day one, hour one. So if you've been in a 30-year mortgage for 5 years, you can add up your principal and interest over the life of the last 5 years, and you can see that those two numbers add up to the same number, and they will for the 30-year of the product. You'll start high in interest, low in principal, and around that 12 to 18 year mark, you'll see more in principal than you do in interest. But you have to wait 12 to 18 years. And that depends on your interest rate, of course. And my thought is, well, why would I want to apply all of this money to interest, not pay my mortgage down? And then the typical homeowner in the United States lives in a home for 7 to 10 years. You're always giving the bank their money, and you're giving it to them at an expedited rate where you pay 27% of total interest in today's interest rate market in just the first 5 years. So a really crazy statistic is at a 5.625 interest rate, which is a pretty good interest rate in today's numbers. And heck, it's even a pretty good interest rate over the life of mortgages since they've been developed since the Great Depression. But if you have a 5.625 on a $300,000 mortgage, you're going to spend 100% of what you borrow in interest. You're spending something like $60,000, $70,000 in just the first 5 years, while your mortgage balance barely even drops. We're trying to throw out the concept of old mortgage thought processes and bring in a new concept. Not really, it's not that it's new, it's been around in the world since 30, 40 years ago, very popular in Europe and Australia, pioneered here in the United States in the early 2000s. So it's not a product that just hit the market last month and you guys are, you know, the test subjects. This has been proven, and I've dealt with countless people who've called me 5 years after doing one of these saying, hey, I paid my home off. And I've only spent $70,000 in interest and my home's completely eliminated, which is just such an amazing feeling and really an amazing conversation to have. So to talk about more specifically, after you get into a product like this, we want to kind of walk people through, well, what's next? Because many times and I know Chris's team and everyone on this call doesn't say, hey, here you go, here's your widget, see you later. It's no, now that you've gotten into it, now let's walk you through what this can be used for and how crazy it can help you achieve your goals, how crazy fast it can help you achieve your goals.
But Harrison, there's one thing I gotta call out, and a lot of the folks on here, we got 136 and climbing, are probably thinking, well, why the heck would I pay my mortgage off when they've got one of those amazing once in a lifetime deals where they've got a 2.5 or 3% mortgage over 30 years? Like, what do you say to people like that? Because I mean, listen, they make a viable case to that. Like, they've got a mortgage that they're paying 2.5, 3% on, and they're like, hey, why would I ever pay that off? I could take any money, put it in a high yield savings and make more than what my mortgage is costing me. Or are the banks winning there too?
They're always going to be winning in that instance. So there's kind of two answers to that. It's one, that's amazing. Congratulations. You won the interest rate lottery. It's possible that for some individuals, depending on their equity position, depending on their income, and quite a few other factors, yeah, maybe it doesn't make sense to look into this. But the opportunity cost that many people are just foregoing by leaving that $250,000 of available equity sitting in their home, trapped in the walls. Steven brought a hammer. I kind of wish that I had a hammer so I could smash into the walls of my house, pull out that money. Well, this is actually a way for you to not destroy your wall, but actually get access to your funds so you can deploy them elsewhere. Because at the end of the day, not having access to money is just as risky, in my opinion, as having a 30-year mortgage. Everyone says, "Oh, my 30-year mortgage, it's not risky because my I know what my payment is." And I completely disagree with that. The only reason it's not risky is because you know what your payment is. But arguably, the amount of money you're spending in interest, even on a 2.5 or 3% 30-year mortgage, is costing you money and it is hindering you achieving those goals of early retirement, spending more times with your kids, growing your family, the important things that happen in everybody's life that we don't want you to put pause on because you have this new brake system you need to put on your car. Your car just got towed and now you can't go through the process of beginning your family.
There's another interesting thing, and this is we've done a lot of study on this, and I think it'd be interesting for everybody here to know this is, when you look at banks, you remember we said banks always win. You got to give them some credit. Banks are pretty freaking smart. They've figured a lot of things out, like they've gone in and figured the statistics out on how often the average person moves to a new home, like buys a new home or refinances their existing home. Then when I started digging into that, because that answer is every 5 to 7 years, the average person will move to a new home or refinance their existing home, or restarting the amortization clock, which if you understand that, like Harrison just explained, in a mortgage, in the first 10 years, the majority of your principal and interest payment, your mortgage payment, goes to interest. So are you really paying 3% if you keep a mortgage for 5, 7, or 10 years? No, you're paying significantly more because it's front loaded. But then when I got into that, I said, you know what? And I started looking at Ray Dalio's debt cycle, the short-term debt cycle, which just so happens to be every 5 to 7 years. So what that means is every 5 to 7 years, we go from a low interest rate to a high or a high to a low, like the cycle changes. So of course, it makes sense. We're coming from a low interest rate cycle. Remember those magical lottery winners who got those 3% mortgages, to a high interest rate cycle where we're at today, or what most people of any age say is the norm. And then we're now entering another cycle where rates are supposedly going to start going down. They said that there should be 2 rate decreases this year. And I know, over at CMG, I know you guys are already baking that into some of the mortgage pricing because it's pretty much a done deal. September is going to be the first drop. So it makes perfect sense how a bank would look at that and say, okay, every 5 to 7 years, we know somebody's going to change, what they're doing. They're going to restart their mortgage, do a cash out, a refi, or move to a new house. So what they've done is they've designed the amortization schedule so that in those first 10 years, they get all their interest up front. Listen, folks, it's freaking brilliant. You can't say anything else. You can be like, oh, those damn banks, those scumbags. You can say whatever you want. All I'm going to tell you, brilliant. That's what they are. So that's exactly why you got to change the rules on how you play this game. And that's what we're doing today. That's what we're going to get into. So Harrison, I just wanted to bring that up because I don't think a lot of people know that. I think they think that, they're paying 3%. But let me ask actually the 144 people. How many of you on here have held your house or your mortgage without a refinance? You've lived in the same house. You've never refinanced, never cashed out for longer than 10 years. How many of you have been in the same house, no refinance, never did anything with your mortgage for 20 years? Put I am in the chat. Those folks are the only ones who are literally even getting close to realizing the interest rate that was written in their mortgage. That's important to understand. Harrison, sorry to steal the thunder. Keep on going here. Let's roll this thing.
I think it'd be almost even more curious to know how many of you wish that during times of low interest rates that you had taken cash out so you could have used them for something else, whether that be paying off debt, buying a new house, sending your kids to college, getting a new vehicle, landscaping, renovating, unlimited options behind that question. It's what could have been done, and wish that we could see that take place in a path.
All right, well, let's get into it a little bit. So today what we want to do is we want to show people how they can change the rules. And to change the rules, essentially they just got to take back that banking function. Because if the banks are so smart that they've figured that out, well, let's figure out how to do it ourselves. And the only way to do that, well, go create a bank, right? Create a private bank, or just change the way the interest is calculated and the way you access your money. Because I know, here's one thing I would always say, and this is something that we're going to let Craig get into, but with debts, when I hear people, and we talk to hundreds of people every single week here, folks, and I'm not going to embarrass anybody, but I can't believe how many people we find that are investing money, 401ks and everything else into the markets, but yet on the other side of the spectrum, they've got a bunch of high interest rate debt. They've got high interest rate car loans, high interest rate credit cards, high interest rate lines of credit, whatever. They got all these high interest rate loans with a blended interest rate that they're paying of roughly about 15%. But then they're shoving as much money they can into this 401k, into their investment accounts with advisors and so on, trying to make what would be, I guess, the average, Craig, the S&P 500 average, 7 to 9%, right? So you're trying to make 7 to 9, but you're paying 15 average. Let me repeat that. You're taking tons of risk on and investing in things that you likely don't know, like, and understand to make 7 to 10%. When you're over here with your debts paying 15%, wouldn't it be easier just to find a way to pay off the debts that you're paying 15% interest on, then recapture and recycle the money that you were paying to those debtors back? And now what did you just make? Well, you just made 15%, because if you were giving 15% away, and now you're making the same payment you were making to those debtors back to yourself because you paid all those debts off, you are indeed recapturing 15% interest, which is the same as making 15%. But it took you no risk, zero risk. You just took back control. So much of what we teach is that. But up to this point, it's been so conceptual. Up to this point, it's been us telling you that this is smart, us showing you that this is smart. But what if math took place of all of our voices? What if we just shut our mouth and mathematics just showed you that that is the smart way to do it? Because that's exactly what this is, folks. It is truly an exercise in mathematics. Some might say an exercise in imagination and creativity and a lot of different things, but an exercise in mathematics is truly everything that we are doing and everything that we are teaching here. Because that's all it is, pure math. Some of you would say, no, I'm going to pay less on a 3% mortgage than I would on an 8% line of credit. Says who? Let's look at the math. Because I can tell you probably 9 out of 10 times of that example, we will show you that paying 8% is cheaper than paying 3% if you know how to do it. So Greg and Harrison, what would you say to that? Because that sounds stupid, man. People listening probably think I'm really dumb for saying that. They're like,
I agree with your statement about math. We have a saying early on, it's not magic, it's math. Realistically, we're not looking You're calculating apples to rocket science. There's no comparison between a 30-year mortgage, the most basic thing that benefits bank and has always been the benefits to banks. Because the people, the bank, is essentially telling you, hey, here's how you should make your payments. The people that want to take your money in are giving you the advice. I think that's kind of a conflict of interest at the end of the day. The people that are showing you what you need to do are the same people benefiting every single day from your actions. Let's not be, yes, let's be our own bank. Let's not really essentially uh, change the rules around all too much. We should just play by the same rules that the banks are playing by. Let's take advantage of all the advantages that they have and earn our own money or save our own money in a way that is so much greater than what we could do in a standard 30-year mortgage and slowly chip away our balances. And you hit the nail on the head just a second ago. It's not as much conceptual. You walked us right into what can you do then? And that's really something that Greg and I have put together. We call it the Oreo of the AIO. We're excited to walk you guys through what this is today.
Frankie Ibarra, I believe is how you'd say that. He said, page number 3 on the closing document, read the TIP number. That's your actual interest cost. See, that's a beautiful thing. I don't know how long ago it was, Harrison, but there was a point where like there was a big dispute over whether or not people were actually paying the interest rates stated on their mortgage, and they found that they're not. So they actually had to show what the actual real interest rate is. And Frankie was nice enough to kind of share that on page 3 of the closing statement, there is the actual interest you're paying on your magical lottery winning mortgage that you've got. Is that correct?
That's correct. Stands for total interest paid, and it's on every document that you will get during the transaction. You could also just go into a 30-year amortization calculator almost anywhere on the internet, and it'll show you your total interest paid. But yeah, they have to show you that information. Again, it's somewhere else, not really where your eyes are drawn to, because as you could imagine, when people start to see, oh my gosh, I'm paying 170% of what I'm borrowing in interest, you can see where probably people are going to be a little frustrated.
Yeah, Frankie then says facts are stubborn things. It is interesting. That's a very interesting thing.
I
So,
like that.
out of everybody here, how many of you like Oreos? I know I do. You know, I
I
grew up
love
on
them.
those things. I know they're terrible for you. They're
Double
probably not even
stuffed.
real. Yeah, terrible. But y'all like Oreos? All right. Well, let's talk about the Oreo. Take it from there.
Beautiful. I'm going to share my screen, guys, and kind of go through all of this. All right. So the Oreo, the acronym of Oreo that we've come up with is going to be obliterate. Let's obliterate our debt. After we obliterate our debt and we've paid off all of those unnecessary high interest rate credit cards, let's walk through building up reserves. Again, the reserves in this loan sit against the balance of your mortgage, meaning that as your balance goes down, your payment goes down with it. Building that snowball, allowing for you to save more money as you save more money. It's kind of a simple concept once you get a handle on what this product can really do. The E, it's going to be expansion through strategic acquisitions. That's going to be depositing funds into a whole life. That's going to be doing rental property, starting your own business, building another engine that allows for you to take advantage of new income to, again, pay that back down, optimize, and eliminate again. Once we build that engine of additional income coming in, we're going to take that money, put it back into our loan, and we're going to pay that balance down again. We're essentially going to see a cycle of where we pull money out to pay off our debt, which allows for us to save more money faster, building up 1, 3, 6, 12 months of reserves of our typical household expenses, allowing for us to say, great, I want to take that $20,000 that I've just built up. Yeah, I have a cushion of another 20 over here. Let's pull that out, deploy it somewhere. That's where the guys on this call, myself and Greg, are going to be able to say, hey, based off what your goals are, here's a couple things and ways that you could pull that money out, deploy it into your new vehicle. Not a physical car, but a new engine that is bringing in other funds. And now that you've acquired that new asset, that new income source, we're going to work on taking that money and paying off with our normal income over here, that same amount of debt on top of our normal house debt. That is the overall concept philosophy behind getting into a product like this. So to get a little more specific, let's talk about obliterating debt. Obviously, all of our money goes into this balance on this mortgage. That money gets applied to our overall balance, which our payment is only going to be calculated off of what we owe. Still keeps you 100% liquid. After all, it is your checking account. And then through understanding when your bills get paid, many people will say, "Oh, I might have to pay my electric bill today. Oh, okay, I need to pay my credit card bill. Okay, I need to pay this my insurance and so on." If we can habit stack, figuring out ways that we can use that bank's free money on credit cards, because the banks will let you use their money for free for a very short period of time. If we can habit stack and say, "Look, I make my money on the 1st and the 15th. My bills are not due until the 28th. Don't pay them off on the 14th because you're not taking advantage of those extra 14 days, almost half of the entire month of where your balance, your money can be sitting against your home until you get to the very end of the month, and then you can pay your bills off." This isn't some overarching complex understanding on how to do it. It's truly just, let's make sure we're not wasting days by paying off things that we have access to free funds for a short period of time. Now, how do we get there? This loan has an integrated checking account. Your money, as opposed to going to Wells Fargo, can get deposited directly against your mortgage balance. And it's not like, oh, you deposited 10,000 and you only get access to 2,500. No, you deposit 10,000, you have access to 10,000 just as fast as you do in your current checking account. Now, the bill batching, the habit stacking and win by timing, all of that is the same overall arching thought process. Let's pay our bills off at the very end of when we need to pay those off, because every single day that that balance remains lower, that balance is calculated off of your payment is calculated off of that lower number. We can then take advantage of some individuals that receive tax refunds or bonuses or maybe even commissions. There's plenty of times where people say, "Oh, yeah, I'm part-time firefighter during the summer to take care of wildfires." Okay, great. That money is certainly not going to be an annual income, but let's still take advantage of how that looks. Let's say that you make an extra $1,000 for 5 or 6 months out of the year. Well, that's a big number at the end of the day because most people on those bonuses and tax refunds and so on aren't living their life expecting that money to come in because it's never going to be expected. Those are massive debt eliminators in a product like this. And then as you get better at habit stacking, you can build that pay down schedule on saying, "I have this one credit card. I go out to dinner, I get groceries, and I pay for gas." And that's pretty much it. That's the lifestyle I live. Great. Make sure you take advantage of those cards that say, "Hey, you get 3% cash back on groceries. You get points when you pay for gas." Let's take advantage of the bank giving you those points so you can fly on that next trip that you want to take with your family without ever actually needing to pay a dollar in either interest or in travel expense.
So, guys, we're going to talk about reserve accumulation. And before we jump into this slide, I just want to kind of give the analogy here. Harrison came up with this fancy acronym, Oreo. He thinks it's snappy and it presents well. And he's right, right? Oreos are delicious and we think it's snappy too. But the thing I want you to think about, not only do we have an acronym for it, but the O at the beginning and then the O at the end are like the two cookies in the Oreo, right? And then the frosting or whatever the white stuff is, you never really know with Nabisco, but the frosting in the middle is the R and the E. So we're going to talk about the R and the E now. Okay, debt accumulation on, or excuse me, debt elimination on both sides are the cookies on both sides, right? That's part of the imagery and the analogy of the Oreo. Plus, they're delicious. So when we talk about reserve accumulation, once you've done your debt elimination, right? Once you've aggregated all of your high interest debt, you've paid that off from the equity in your home. You're now paying simple interest on that money instead of paying 27% on your credit card or something ridiculous, right? Once you've done that, your principal is going to start falling faster. And this is simply because your cash flow on a monthly basis has increased. As your cash flow has increased, assuming you don't take on new additional debt, that cash flow goes to reducing your principal. As your principal falls, your cushion in the all-in-one grows. Let's say you started out with a line of credit amount at $500,000. You paid off all your debt, and after 6 months, because of this extra cash flow, you've now got a balance of $460,000. You've got a $40,000 cushion, right? Your emergency fund effectively can live inside of the all-in-one. You've got $40,000. It's usable equity, usable funds, should you need them. Now, we hope that you don't, but God forbid a kid gets sick, or you have a big car expense like Chris alluded to earlier, or something comes up that's unexpected, because life happens, right? That's why we have emergency funds. You can now leverage dollars that would be normally loitering in a savings account to actually offset your principal balance in this product. So your emergency fund lives in the all-in-one. And so from a planning perspective, we want you to think about this in terms of milestones. Once you have 1 month of your monthly expenses housed in the all-in-one, that's your first milestone. Then we get to 3 months. Then we get to 6 months of expenses. We set healthy habits, and we see this start to grow as you leverage the funds saved into cash flow to lower your principal balance. Anytime you have idle cash, right? The money that maybe you're starting this process with a reserve account. Maybe you already have an emergency fund. It's sitting in a high yield savings, making you 3.2%. And you're feeling pretty good about that. Well, let's move that money. Let's bring it into the all-in-one. So instead of making 3.2% in your high yield savings, you're offsetting 7 to 8% of simple interest. Sounds like a pretty good deal. And you still have access to the money. You're not taking that emergency fund and making an extra principal payment and locking it into the walls of your house. Nope. You're reducing your principal and you're maintaining liquidity. So you have access to all the funds should an emergency pop up. You're paying less than your principal on a monthly basis, and you're on the road to the next step in the Oreo expansion.
Boom. Now we're on expansion. So we're going to expand through smart asset acquisitions. At the end of the day, what this really means is let's take the capital that we've built up. Yes, we've built our reserves over here for any potential heartache that may happen, other expenses that come up. But we're feeling pretty good. We're taking that line of credit that Greg just said, $500,000. And now we're not 6 months or 12 months, but we're 18 months into it. We owe 380 grand. We have $120,000 of available funds. Now, obviously, this is just an example. Each individual scenario is going to be a little different. Some people are going to pay their debt off faster because they already have no other credit cards. They have a good savings account. Other people are just saying, gosh, if I could just pay off this $40,000, $50,000 of credit card debt, that'd save me $4,000 a month in expenses. Whether your path is option A or option B, this expansion is going to be something that happens in the thought process and the psyche of the path of this product. Essentially, we're going to take that asset available line of credit we had and put it into this other investment. We put a flywheel here because as you start cranking a flywheel, that 150-pound piece of momentum is going to continue to spin faster and faster. And as you deploy that energy elsewhere, you're going to say, great, maybe I do a quarterly $7,500 a quarter whole life policy. And as we work our way around the monopoly board, that's just another bit of energy that we've taken from the flywheel that we've slowly put back into our system. Now, how do we get there? Obviously, we mentioned whole life policies clearly, but there are other ways to add energy to flywheels, just diversifying that path, whether you're putting it into rental property, short-term or long-term rentals. Heck, whether it's a commercial property, you have the ability to start a business. Or in many instances, depending on where you are at your life, maybe you don't want to go down this expansion route, and maybe you just want to spend a little more time with your family. You want to retire in 5 years, not 10 years. You want to be able to go on a cruise with your wife because you have grown kids. Whatever that is for you, because I'm not going to tell you what your goals are, because your goals and my goals are probably not the same goals. What you're looking for is a huge component of how everybody on this call is going to want to guide you down that path. What are you looking for? How can we help you? That is the biggest question I think every single person on here is going to agree on, because if you don't know what you're looking for, it's hard for us to provide guidance on how you can get there. But I think that I can probably speak for everybody. Spending money unnecessarily and putting it into somebody else's pockets, the bank's pocket, is not a way that people are going to wake up and say, yes, I'm so excited. I made my mortgage payment and $1,900 went to the bank today. I feel great. Only 180 went to my principal balance. Almost there. I really think that this expansion, once you start building up enough equity in your home, is going to help individuals build not just their lifestyle today, but generational wealth.
Yeah, correct. And so I'll reemphasize what Harrison said. We're talking about hypotheticals and how you can leverage the all-in-one, and we're using the history that he and I both have working with borrowers. There's a phone call that we both get fairly regularly, and it's a phone call from borrowers that have had the all-in-one for somewhere between 3 and 5 years. And they call us and they say, Harrison, Greg, and we're kind of wondering like, yeah, what's this going to be about? I've got this all-in-one. I've been working on it. We've been doing all the things you guys said. Okay, good so far. And my balance is down $200,000. Oh, that's great. We love that. And so the next question inevitably becomes, so can I use that $200,000? And the answer is yes. And that's that expansion, right? The opportunity to leverage your funds to accumulate cash flowing assets, whatever those are, right? And Harrison went through a list. So let's just make the assumption that for the sake of this example, that's where we're at, that you've gone through the process, you've eliminated debt, you've stabilized, you've increased reserves, you've expanded, and you've accumulated some degree of cash flowing asset. Now we're to the other side of the Oreo. Optimize and eliminate debt again. And so this will look a lot like that first O slide, right? What we want to see is that now we leverage the new income that you've come into. So let's say you bought a rental property and your cash flow on that rental property over and above the mortgage on it is $500. So after you pay the mortgage and you pay your property manager, you take care of expenses, et cetera, you have $500 that property has produced. What we would suggest is that you take that $500 and you put it into the all-in-one. The funds that you use to acquire the rental property, in addition to your income, your budget, you now have another $500. The engine is now bigger, right? You have more ability to pay off this debt faster. And so it actually accelerates the debt pay down. Again, I love that HELOC Joe said this a couple of weeks ago. He said he's paid his home off 4 or 5 times. And if you don't know what he's talking about, you're like, HELOC Joe sounds kind of crazy. What's he talking about? That's weird. But it's because he's leveraged his home and he's leveraged his HELOC to accumulate wealth and then to pay down the debt associated with it. So he's just got this thing rolling, and his engine, should he decide to send out funds again, is now bigger and bigger and bigger to pay that debt down. And so again, let's say that you've got this $500 a month that's cash flow from a rental property. With your regular budget that you were using to pay down the all-in-one, plus the $500, then you pay down that balance again. You reduce, you reduce, you reduce, you reduce. And when you get to a point where you've paid off the debt that you took out to acquire said cash flow asset, you now have a budget that's plus $500 with no additional debt because you're leveraging what the all-in-one can do. Again, from a system perspective, the all-in-one does most of this for you, but you can continue to optimize it, right? We want to make sure that auto transfers for rents, dividends, business incomes go directly into the all-in-one, right? We want that to be just automatic, right? Where you don't have to think about it. You don't have to mess with manual transfers unless you're in Texas. And then we just make sure that you're optimizing those things, right? We want to make sure that your bills are still batched towards the end of the month, that all of your budget, all of your income is still coming in. And then you basically just have either a quarterly or a semi-annually meeting with one of us. And we look at it and we say, or anybody else on this call, we look and say, how do we trim the fat? How do we continue to optimize this? Because you don't just set this thing once and then never look at it again. You pay attention, you look at the details, and you make sure that over time it gets better and better and better. And that's how we think that the Oreo should work.
And last
Also,
thing to hit off
these
of,
are delicious.
yeah, I wish I had one. Last thing to hit off of Greg's thing is that it's not just the cash flow of $500 because you still have that mortgage payment you can push out towards day 8, 9, 10, 11, 12. And if you receive rent all 2000 on the first day of the month, yeah, you know, you need to make a $1,500 payment here. But for 10 days, you're taking advantage of the full $2,000. It's just this hyper efficiency use of this product.
Joe, you've been using this for a while. like, can you just talk a little bit about like some of the things you've seen? Because I know you talk to a lot of people about this exact strategy, showing them how to pay down debt and all the different things you heard. So just give a real scenario of like how, not just how you've used it, but how so many of your clients are doing the exact same thing.
So many people they'll keep money in a checking account or a savings account and tell me that they still, that they, oh, I only owe 20 or $30,000 on the HELOC. And I said, well, why, what is that money doing in that checking account for you? It's like purgatory. You're not making any interest on it. It's doing it nothing. Why don't you take that money and put it in your HELOC until you need it? So some people are thinking that way, that they're trying to keep the apples with the apples and the bananas with the bananas. And you don't pay your gas bill with red money and your electric bill with blue money. You pay it all with green money. The green money should stay together. That's why when I talk to people, I use the one pot system, and that the HELOC is my checking account, my savings account, and my investing account. When Greg was talking and that money was come back in, well, I would acquire it up to like 50,000 or 100,000 and then deploy that to make more cash flow. So it might take me 12 months in order to accumulate the first 50. But once I sent that 50 out, now with that extra cash flow, it's going to take me 11 months to get the next 50. And then as you keep on deploying that, you'll come to a point where every month there's 50,000 now. But you have to keep on using the system and keep on running it through.
I want to hit a question. There's a few questions I want to hit. One, I want to address to Greg and Harrison. Mark Perry had said, isn't this commingling of funds? How would you address that? Referring to the Oreo.
Yeah, no, so there's a couple ways to go about it. One, most of the times, the way that the IRS, and again, I'm not a CPA, I certainly recommend connecting with a CPA, but most of the hurdles associated with taking rental income in is really going to be just seeing the path that it goes through. So if the money comes in from a rental property and goes into that bank account that you have, 123 Front Street linked up to, and you move the money over, it's really just an accounting problem more so than anything else. Really, it just means more work for your CPA so that they don't need to so they need to collect a little more information, which means that they have to do a little more work. Obviously, in most instances and most CPAs, they want to do as little work as possible because they're up until 4 or 5 in the morning during tax season preparing taxes for plenty of people. As for business income, and if businesses have plenty of assets, now, I'm not recommending this, but by all means, I've seen individuals take loans from their business and lend it to themselves at ridiculously low interest rates. And now they're paying themselves back from their all-in-one. Again, if this person has 100 grand in their business account, and as long as it doesn't impact business flow, they could take a loan of $50,000, apply it to their mortgage, let it sit there, and they can make a 1% interest payment back to themselves. That business now has this other source of income. It's just figuring out how other people do it. I mean, some of the richest people in the world, Elon Musk, they don't really make any money. They take loans against their assets, their
Right.
stocks in their companies, and they don't pay taxes on that money. That's why their tax basis is so low. What they do pay is interest. And when you're taking money out of a house, whether you pull out 50 grand in a cash out or in an all-in-one, you don't pay taxes on it because the implication is that you're paying interest on it. So just working the system, talk with your CPA. If your CPA seems to not understand how this product or how stuff like this works, I'm sure that there's plenty of people out there. We'd have introductions as well for individuals that might be and I know Chris certainly does, that might be more of a right fit to say, hey, I don't think that your understanding and what my goals are kind of in line. Ask the
Yeah.
questions. Great question, though, Mark.
Yeah, it really was. I mean, what you just said about Elon, and I mean, there's so much out there. Elon's just very public, so you do hear about this in in the news, where they just use debt, right? They, at that level, a lot of them are using margin accounts against stock portfolios, or like in Elon's case, like he has so much in stock in his own companies, which he then leverages, okay, i.e., kind of like what we're talking about. We're going to leverage the equity in your home, same difference. He leverages the stock in Tesla and all of his other companies, and then they give him money, liquidity, which is basically just liquidity of the value of his stock. Now, if his stock goes up, great, he has more availability and more liquid. If it goes down, he has a lot less. And you've heard those stories. So everything we're talking about here is you're doing the same thing as the wealthy. You're doing it with a primary house. And I want to get to Key Ogden's question because I thought it was a very interesting one I would have never expected on a webinar like this. But also when you go to the infinite banking concept, it's kind of the same thing. We're leveraging money in the general account of the life insurance company and a contract that promises a future payment of a death benefit. Now, I know I could probably ask all 140 plus of you, if you all want to wait till you die so that the money is available, you'd all say no. At least I hope you'd all say no. So what we do with IBC is we show you how to take back the banking functions utilizing a very specific contract, language in a contract, a guaranteed vehicle, and leveraging the death benefit. That's exactly what we do. We're going to get more into that in the mathematics, but let me hit this before we go to the next segment. And I love the next segment because this is where we're going to talk about borrow smart, blast debt away, and bank forever. I love that topic. But here, Key Ogden said, and pay attention, this is a kind of a in-depth question. He said, BYOB, be your own bank, and velocity banking work well at the household level. Meanwhile, central banks and WEF-backed funds, is what he's saying, are using far greater capital to buy up homes and land systematically, actually. So that's true. Like those big private equity firms, those big funds are buying up properties at alarming levels we can't even comprehend. But keep going. With home ownership on track to decline rapidly, do we risk teaching people to play a game that the larger players have already rigged? Interesting point. What happens when the very asset, home equity, becomes increasingly out of reach for the average family they are already scooping up through PE, private equity? Don't we need a new strategy to accelerate your ecosystem and others pre-prepared so we can grow the middle class while there is still freedom? I love this question, just so you know, like it's deep. So, and there's so much truth in this. I want to point out some things that we typically would never do, but because the question came up, this is very important. And I also want to use this to segue into the next part, because we're going to use mathematics to show you how to rig the system that's already rigged against us, okay? We're going to literally use mathematics. We're going to use technology, which is key. You almost can't do what we can do today. It's funny. I've never really thought about this, Craig, but what we can do today, right now, this brand, this thing that we're going to offer for the first time today is going to change the game, because it's going to allow the average person, the middle class, if you will, do things that the big folks can't, because it's going to put that technology in their hands that the big folks, the private equity, have. But let's just talk about some of these things here. The system that's rigged, of course it's rigged. It's 100% rigged. Okay, it's rigged against us. They literally, like PE. Let me point out something that most of you don't know. Private equity. Private equity uses credit, but that credit leverages whose money? Does it leverage their money, the funds, the private equity companies? No. It leverages our money. And I know you've never thought about this, and I don't talk about it because it's just too deep, and it's just actually, it's kind of depressing. They leverage the money in the pension plans. They leverage the money in the 401k plans. Okay? Though that is not their money. It is your money. It is our money. Our money that backs our retirement plans that we were promised. Our money that backs our 401k retirement plans, right? All of that money is being leveraged, just so you know, by private equity. Okay? And they're using that to take risky ass bets to try to get fat and wealthy. And they are doing a good job at that until they're not. Second thing, okay, that's the rigged system, okay? You can't play the same game no matter how much you learn, no matter how many webinars you're on, no matter how many of my YouTube videos or anyone's YouTube videos, you can't play that game, quote unquote, because you can't leverage a pension's money. You can't leverage everybody's 401k. You don't have that, okay? And you probably never will, so let's just leave that out. The second part of this was the home equity piece. What happens when the very asset, home equity, becomes out of reach for the average family? I would tell all of you right now that that day is upon us. The price of housing today is out of reach for the average middle American household. It just is. Believe it or not, that is out of reach, which is why there is such a housing demand, okay? Affordable housing demand. Let me quantify that. Not a luxury apartment demand, not a luxury house demand, A affordable housing demand in this country is massively needed right now. Therefore, what he's saying is that thing that we're talking about, home equity, is out of reach for new people, for younger folks, Gen Z. Okay, and just so you all know, Gen Z, from a saving standpoint, is saving more money than any other generation in history. So put my hands together for Gen Z. I just found that out the other day. Let's go one step further. And it says they're scooping up all the real estate. Well, that's impossible to scoop it all up because some of it's just not for sale. So everybody on here who we are talking to, everybody that Harrison and Greg and CMG is talking to, guess what? They own houses that are not in most cases for sale, but everything's for sale for the right price. But for right now, we're trying to get them to use a rigged system in their favor and change the rules because they can. They have the equity. Okay, the equity is what private equity is using against us to then go out and buy more property. So you can do the same thing private equity is doing, just at a much smaller level, but you can do it. And the other thing I want to talk about is because houses are so out of reach for the average American family, like what are they going to do? Well, literally, like I hate to say this, I do, but if something doesn't happen with the price of housing, which I don't know, I mean, a recession would kind of reset the system, which is long overdue. So I hate the sound of that. And all of you should hate the sound of that, but that literally is the cleansing that we kind of need to reset the system. But you literally could see a future where the average family no longer believes that home ownership is like one of those dreams, one of those things that they work for. It's not the American dream anymore. Home ownership, the American, that was the dream, the American dream of the silent generation, of the baby boomers, maybe even my generation, the Gen X. But it's not the American dream for the generations that will come. Okay, so we all have to realize that. So when you say, like, how do we teach something that accelerates the ecosystem that will exist in the future? Believe me, we are. The infinite banking concept is that. Okay, this technology you're going to see in a second it is now going to be available to every single one of you, will put you in the driver's seat, will put you in control, and will allow you to some extent to compete with, yes, even private equity. You're not going to compete at the scale, but you can compete playing the exact same freaking game they're playing. Does that sound good, folks? Like, I mean, if you could clap and we could hear you clap like I can in a live audience, like everybody would be putting their hands together. Like Key Ogden, like nailed it. But the thing we got to do is we literally have to now focus on exactly what Harrison and what Greg were showing you, because this is the game. And if you're not using it, you're losing it. Did you hear me? If you're not using it, you are losing it. If you buy into the lies you've been taught your whole life when it comes to money, you're losing the game. Period. You will lose. No ifs, ands, or buts about it. You're already behind the 8 ball greatly. It's time to accelerate. It's time to accentuate. Whatever word you want to use, it's time for you to get back in control of your money. And that is the only thing. So like when people online bash me and they say, oh, scam, this, Ponzi, all this crap, I'm like, f all of you. Excuse my language, but I'm from New York. I have a license to swear. Okay? That's exactly what I say because I know I feel bad for them. Because if they knew what I know, they wouldn't be saying that. They'd be so much further ahead, but they don't. For them, just saying it's a scam, saying that it's not real, saying whole life sucks, saying all these things that they say is simply because they don't understand what we understand. That's the cool part. So I feel bad for them. I don't get mad at them. And what we're going to show you next is something that's been a 2-year project. Okay, something Craig Yenny, only somebody who is a master in the sheets, okay, like Craig Yenny, and I mean the Excel sheets, only somebody that understands coding and engineering and in true mathematics could ever solve the problem that we solved. And I don't even want to say we. He solved it. I just gave him the platform. That's it. And you're all going to have access to this thing that has been 2 years in the making. And this offer today, which we're going to call the early bird, I want you all to remember that. We're going to show you how it works. We're going to show you how to use this thing, okay, which is at your fingertips, on your phone, your iPad, your computer, whatever you're on right now, that is your machine. That is the engine you're going to use. We did the rest mathematically. So Craig, I know that's a long intro, but let me turn this over to you where you can talk about how to borrow smart, how to blast debt. Debt is the enemy, folks, just so you all know. And there's good debt and bad debt. So I know some of you are like, well, you're talking about debt. You're talking about taking out equity from my house and using it. That's debt. Yes, but it's good debt because that debt can go out and do things if you're smart about it, if you listen to what we're teaching you, and if you apply this technology, that debt becomes really good debt because listen, banks use debt, PE uses debt. They just know how to make the arbitrage. That's the game. That's what Ogden was saying was rigged. It's not rigged at all. They know something we don't know. Just get to know what they do, learn how they do it. It's called arbitrage. It's a spread that they make. They're all using debt, folks. Make no two ways about it. So you're going to do the same thing, but you got to use the debt and the leverage that you have available, the equity in your house, the cash value in your policies, whatever that is, you got to use it. But we're going to bring it all together where we're going to talk velocity banking, IBC, the all-in-one system that we just heard them talk about, and the Oreo, which kind of brings it all together, all at your fingertips. You don't need to understand this stuff so much anymore because the computer does and the system does and the technology, as long as you understand what your goal is, the rest is going to be done for you. So Craig, take it from there.
Yeah, and what we're going to do is dive into, the Oreo in more detail, but the O, the obliteration of debt. And so we're going to focus on that initially. And I love that Greg ate the Oreo already. I'm hungry. I'm sitting here watching me eat the Oreo. I wish I had one myself. They got the whole stack here. But anyway, so what we're going to do is focus on that O, the obliteration of debt. Now, I know Joe and I do quite a bit of what we call strategy calls. We talk to a lot of people. And Joe, I'm sure you'll agree with me. We meet people that aren't ready or able to do infinite banking yet, right? So what we're here to do is we want to help you get to that point. And Harrison and Greg, you're in the same boat. There may be people that want the all-in-one, but there's some prep work before you can get to the all-in-one. There's some prep work that might need to be done before you get to the infinite banking stage. So we want to understand that. But what I want to share with you today is a system where whether you can start velocity banking with an all-in-one, whether you can do an infinite banking, there are steps that you can take to get ready. So if you're sitting here watching all this and you might be a little discouraged, like, I've got so much debt, I've got car loans and student loans, I've got all these things, I can't get to this Oreo thing. I can't get to the full, the creamy part in the middle, and I can't get to that last wafer. Then listen up, because what we're going to teach you is where you need to start, and then we're going to give you a path to get there. I call it the debt blaster trifecta, because what we're going to be talking about is how do we organize your debts into an efficient order. How do we attack those in an efficient order? Then let's do some velocity banking. Let's say you've got the all-in-one. Let's do some velocity banking to whittle away at those debts even faster. And then let's bring in infinite banking to talk about how do we build wealth while we're building that flywheel that Harrison was talking about. How do we link all of this stuff together? And I can tell you from my perspective, when I first started trying to unravel all this, it was overwhelming. Like, how do I pay? What do I pay? Where do I take money from? How do I do this? I'm overwhelmed. And I'm sure a lot of people out there today are thinking, I'm overwhelmed. How do I do this? All right, so here we go, drum roll. You've heard us talking about the vault for quite a while, and today we want to show it in a deeper level. So here we go. Chris, can you see my screen okay with the vault?
Yes.
All right. I'm going to walk you through, hopefully in about 25 minutes, just some of the pieces of the vault. We're going to come back to some of the stuff where you see the Ask Chris AI. I'm going to explain a little bit more about what that is, what the policy officer, loan officer, I'm going to show you all of that. But where I want to start, because we've been talking about the all-in-one, we've been talking about the obliteration of debt. Let's just say you have a way to go enter all of your debts. You've got a personal credit card, $2,500 balance, you're paying 24.9% on, and you're paying $75 a month. You have a business credit card, personal loans, medical debt, car loan. So these aren't uncommon debts. I mean, Harrison, Joe, I mean, you guys see these types of debts all the time, right?
All the time.
Yeah, this is the kind of stuff I see over and over and over. So you might be a person that has a debt profile like this. Maybe you have $78,400 of debt, paying about $1,265 a month out to all of these creditors, and you just feel buried, like, what am I going to do? How am I going to get out of this? Now, what I'm going to show you is a few payoff strategies, and the first one I will show you is called the no strategy strategy. And what we mean by the no strategy strategy is, if you have a personal credit card at $2,500 and you're paying $75 a month, what do most people do when they get that credit card paid off? What do they do with that $75?
Spend it.
Yeah, they spend it. They go out to eat more often. They buy more garbage. They don't use it to help pay down the other debt. So that's what the no strategy is. And then there's three others. I'm sure a lot of you have heard of, Dave Ramsey talks a lot about the debt snowball. That's basically where you're taking all of your debts and organizing them into the lowest balance to the highest balance. And then you're using each of those debt payments as you pay off the personal credit card to then go pay off the business card, then pay off the personal loans. You're essentially stacking all those payments to help accelerate the debt pay downs. There's others out there. There's the avalanche, which is organizing things by highest interest rate to lowest. There's cash flow index, which looks at the efficiencies of debt. Now, when we were building this tool, we thought all of those are cool strategies, but I don't really care. Maybe you want to use the snowball, maybe you want to use the avalanche, but what we want to know is mathematically what is the most beneficial. So then what we do is we take all of these debts and we show you what would happen if you do the no strategy. So this is the worst case. It'll take you 181 months to pay off that $78,400 of debt. And you're going to pay $30,000 of interest on top of that $78,000. So you're going to pay a total of $108,000 of debt. So when I show this to people, sometimes there's some gasping, like, oh man, it's going to take that long, and I'm going to pay that much interest. That is if you're not going to get serious and disciplined about your debts. And Harrison mentioned something about habit stacking, and I'm going to steal that. I like the idea of habit stacking. So if you can do some habit stacking and do, say, the snowball, the avalanche, or the cash flow index, in this particular model of debt, we're saying the debt avalanche is the most efficient in terms of amount of time. So you'll go from 181 months down to 80 months. Instead of paying $30,000 in interest, you'll pay $22,000 in interest. So this alone is sometimes what Joe and I will teach people or talk about is, let's get you to a point where you can get some cash flow built. Let's start doing the debt avalanche. Let's do the snowball. And once we have some cash flow, then we can go to the next step. But if you don't have cash flow yet, we need to at least do this step. So in the debt trifecta, as I call it, where we talked about, using velocity banking, infinite banking, and the efficient sequencing, this is step one. This is getting your debts into an efficient order, the debt avalanche. So step one is just simply, classifying and getting your debts organized. Now, let's say that you have an infinite banking policy, and maybe you've put in, a dump in, which is kind of the ability to put in some of that lazy cash from, right away. You get access to about 90% of that within the first 30 days. And then you're structuring an ongoing payment or premium deposit, as we call it, where you're putting your savings into the infinite banking system. Now, why would we do that? We're going to do that because we can get uninterrupted compounding and growth, start to build wealth into our plan while we leverage it. We talked about leveraging, whether it's a margin account or leveraging your real estate, leveraging your home for the all-in-one. In this case, we're leveraging our infinite banking policy. So let's just say we did a $30,000 dump. We have $775 a month going into our policy. So that's how we've structured it. And what we're going to do is every quarter, we're essentially going to utilize our policy to help accelerate our debts. We call that cash value boost.
Hey, Craig,
So-
let me give one thing too, because a
Sure.
lot of people are looking at that saying, I don't have 30 grand. Like some of you don't have 30 grand in your bank, but you got 30 grand in equity in your house. And
Right.
this is what, Harrison and Greg and Joe talk about all the time. Like, what if you just extracted some of that equity from your house and that became your dump in? And then I wanted to get ahead of it, Craig, and say that before you show them what's next, because that is a game changer. But I know a lot of people, as soon as they hear you say $30,000, like, I don't have 30,000. They zone out, the numbers drop, and they're like, it's not for me. But you probably, if you own a house, probably have equity in your home. And if you have equity in your home and you apply the all-in-one, like that is your engine. That's where that money kind of appears out of your walls. You don't even have to knock your walls down. So Craig, anyway, I know you were getting excited to click the button because that's my favorite part too, the gamification. So I just wanted to bring that up.
Well, and it's an excellent point because that's exactly it. And that's why when you have strategy call with Joe, you talk to me or anyone on our team, we're going to figure out what are the resources you have. And we're simply just moving some of those pieces around to get you in a better position. So if you're sitting there on $200,000 of equity and you have an all-in-one, well, why not take some of that, throw it to a dump in into the policy and juice that right away? So let's go ahead and click on this activate cash value boost. And this is where it's now taking the model and saying, let's leverage that cash value that we have growing in our policy uninterrupted, leverage it to help pay down the debts faster. Now let's take a look here. The no strategy was 181 months. We do the debt avalanche, we're 80 months. If we do the debt avalanche and the infinite banking, we're now done with all of our third-party debts in 31 months. However, we're going to be an honest banker and we're going to continue to pay back our policy loans, which will take about 48 months. Now, there's something magical that happens between these two steps. In 31 months, all of those debts are off your record. You've moved those into your private banking system. They're no longer on your credit report. They're no longer public. You've moved all of that debt into your own banking system. And guess what? If you have a bad month or two and you don't pay back a policy loan, there's really no ill effects to your system. You're in full control. That's one of the things we teach is we want you to be in control of your money. So now in this 48-month time frame, maybe you accelerate that. You get a bonus, you get a tax refund, whatever it is, you're paying back your policy faster. But it's still going to take us about 79 months to pay off all those third-party debts and get our policy loans paid off.
Craig, there's a
Here-
vital thing you said in there, and before you go ahead, I want to make sure we understand that is you said you're transitioning the third-party debt from somebody else into your own private banking system.
Mhm.
If you think about just like a bank, right? What we're doing is we're teaching banking. So we're teaching you to be your own bank and create your own banking system. So do any of you know any bank in the world that is not in the business of basically lending money out and creating debt? Like they all hold liabilities on their balance sheet. They all have loans on their balance sheet. Those loans to a bank are not liabilities. They are assets. This what he's talking about, this 48-month pay down where you're recapturing the money that you were giving away, being an honest banker. Remember, that's good debt because now you own that debt. It is your debt, and that money is all coming back to you, not somebody else. That is key. That is very important to understand because a lot of people are like, oh, I still have debt. Yes, but it's the right debt. It's your debt, and it's good debt. That's key to understand. But you still pay it all off in less time, no matter how you want to look at it.
Yeah, and some of the things that we look at is if we just jump down to this total interest paid to others, the no strategy is $30,000 of interest paid to others. Just doing the debt avalanche is $22,000 paid to others. Doing the avalanche and infinite banking, we've now whittled that down to 15. So we're continuing to take more and more control of getting that interest back into our own system. Here's where I get excited is at the end of that 79 months, because you've had money going into this system, you now have uninterrupted compounding of all that savings. At the end of this debt cycle, you have over $100,000 built up if this was your policy and over $462,000 of death benefit. This is the wealth building component of paying down your debts. This is the efficiency stage of paying down your debts, avalanche. Infinite banking is your wealth building. Now I'm going to unwind here a little bit and I'm going to deactivate that cash value boost because what I'm doing is I want to show you velocity banking without infinite banking. So now the scenario would be, let's assume you went out and you got your all-in-one. You now have this all-in-one account where we're going to call that your velocity banking tool. And maybe North Point is your bank and you have $183,000 of limit and because you've used some maybe for a dump in, but you now have $153,000 still available in your all-in-one to use for debt consolidation, to use for your emergency fund, all of those things that we've talked about. So what we do inside of velocity banking is we need to come up with some numbers of what is your income? What are your expenses? How are they getting paid out? What do you have in household, automobile, living expenses? And ultimately, what we're after is what is your monthly cash flow? Because this is the cash flow that's going to go into the all-in-one, and then we're going to take chunks of the all-in-one and throw it at our debts. Okay, so I'm just going to repeat that. We're using our cash flow instead of going into someone else's checking account, we're putting it into our all-in-one, and then we're paying our bills out of that. So every month we have 72.93 going in, and as Harrison and Greg explained, you want to keep that income there as long as you want and batch your debts so that they're paid at the end of the month, because we want to keep that principal down as long as we can. This is essentially the principles of velocity banking. This gets where I've seen people struggle with this is just all the math and the numbers flying around, but we're making it easy with these just hit the button and go. So you type in your numbers, you get your cash flow, and we're not going to leverage 100% of the available capacity here. We're going to chunk it out in like $14,000 chunks. So we're going to throw $14,000 at our debt, use our cash flow to build the all-in-one capacity back up, and then we're going to chunk another 14,000 out. You can do it differently, but this is just how the model initially starts. So now we're going to activate the velocity banking using our all-in-one and our cash flow. Velocity banking is all about speed. So now when we look at the debt avalanche and velocity banking, we're done with our third-party debts in 24 months. It takes us 3 months to pay back our all-in-one. 27 months, you are completely out of debt and you filled your all-in-one back up. You're ready for the next stage of the Oreo to use that available credit to go build more wealth. And so when I look at these numbers, I'm like, holy smokes, look at this. If you look at the interest paid to others, it's 30,000 if you do the no strategy. It's 22,000 if you do the debt avalanche alone. It's $5,822 doing velocity banking. This blows me away. The math of it blows me away. But we're not even done yet. Who wants to see the debt trifecta that shows the debt avalanche plus velocity banking plus infinite banking?
And just so everybody knows, this is the very first of its kind. Never before anywhere else has this been done. And I still even don't know how he figured the math out to do the trifecta, but roll it on.
Here it is. So here's what we're doing. We're using a policy, and we're using our all-in-one, and we're doing velocity banking, infinite banking, and the debt avalanche strategy. So this last column is basically it all together. It's velocity banking, it's infinite banking, it's the debt avalanche. You've got efficiency, you've got speed, and you've got wealth building. Your debts are now paid off in 14 months. It'll take you 10 months to pay back your policy loans, 5 months to pay back your velocity banking tool, your all-in-one. So in 29 months, we're completely done with all of our debts. We've got our policy fully capitalized. We have our all-in-one paid back in full. But check out some of these numbers. Look at the total interest paid to others. It's now down to $2,150. We knocked that down from 30 to 22 to 15 to 5 to 2. And we have over 36,000 of cash value built up at the end of that 39 or 29 months, and a death benefit of $500,000. Now, I'm just going to tell you, if I just left you here, you'd probably be like, well, that's really cool, Craig, but I have no idea what to do next. And so what we've built into this is the ability for you to go down to the GPS, your financial GPS, your detailed payment schedule. It gets really easy from here because on a month by month by month basis, you will see in your velocity banking tool or your all-in-one, this is how much I'm taking out initially. This is how much, everything in the purple is how much I'm taking out of my infinite banking policy. So as long as you can read this and say, this is how much I pull out of my all-in-one, this is how much I'm pulling out of my infinite banking policy, then you just look at all your different debts. And I'm going to collapse this down for us. You look at all your debts and you know, this is how much I pay to my personal credit card. This is how much I pay to my business card. So we've wiped these out month one. All of those debts are gone. Then we start running the excess down into the other debts. And so you just have a prescription here of this is what we do month over month over month. And if you follow this plan, if you follow what it's showing here, this is what you're going to get. The debt blaster trifecta, these are your numbers. So this should be the easy button for you. Now, we also know that as time goes on, maybe your debt balances change. Maybe you added a new debt. Maybe a debt went away. You can come up here and modify this. You can add new debts. You can edit your debts. So it's not just going to paint a picture and say, now go do this, but we realize that people's circumstances change over time. And so it's going to allow you to make those changes, recalculate just like a GPS would, and then go back and get your schedule down here. So anyway, that's what we're doing for the Debt Blaster trifecta. And I know we're about at time, but Chris, do you want me to kind of run through some of the other pieces of the vault just so people know what else they would have access to if they want to get
Yeah, I
into
mean,
this?
the first thing, you know, I just asked everybody who wanted it, who wanted a discount on it. So that's the first that we're going to bring also. We're going to offer this today. Now, we are months ahead of schedule, so there's a lot more coming to the vault, but we figured since it's all working, it's been tested, we've been beta testing this for months. It is ready to go. So we wanted to get this in people's hands because we know it'll change the game for them. And especially now that we're teaching the all-in-one with Harrison and Greg and doing that, everybody's kind of seen bits and pieces, but everybody was probably like, holy cow, like, how do I bring all this together? Well, this is how you bring it all together. And also, Craig, you didn't even talk about the AI functionality. Like, this thing is fully supported and fully integrated with AI. Hence, you see AI Chris and AI Christy, meaning Christy Van. So there are AI, components of this where you can ask Chris anything you want. You can ask Chris what he thinks of Dave Ramsey. You can ask Chris what he thinks about anything. You can ask, what about when do my policies meet their efficiency point? What are my returns and all those things? Whatever you want to know, that's what AI is for. You literally just ask it a question and it does even more than just give you an answer. It then references where that answer came from and you just go down and you just click it. So this is next level, folks. And literally what Craig just showed you is like, I'm going to steal one from Brent, the pimple on the elephant's ass compared to what we're creating here and what this is going to be. But we figured, why not give it to everybody? Why not offer it to everybody? And here's the deal. If any of you want this, there's the link. It's BYOBvaults.com. You go there, you click get started. The plan that we're only offering this on one of the options, okay? It's the $39 a month plan called the policy plan, because it's going to give you velocity banking, give you infinite banking, and give you all those functionalities and a bunch more that we haven't got into. That's normally $39, but we're going to discount it down to $19 a month for the next 12 months if you do it today. Okay, we're only going to offer this Wednesday and next Wednesday, and then after that, you're not even going to hear us talk about it until October. This is like a one and done thing. We just want to test it, get people in, and show you what's available so you can start using it now. So there it is. Okay, it is literally $39 down to $19 a month. So that's how you get it. That's what you do, and keep going.
Yeah, and to Chris's point, the AI, we didn't want to just have it ask a question, give a response, like Chris was mentioning, is you can put in things like, how do policy loans really work? People ask us that all the time, and just think of, what if you had access to Chris's brain? And we've put over 1,000 of Chris's videos in here, wealth webinars, books, Chris's, so it's all tailored to Chris, but it'll give you an answer. And then just like on the Christy Van one, I'll show you here in a minute, it'll take you down into the specific videos and take you right to the point where he's talking about a specific topic. So, this should change. This should be a game changer for just education alone. I don't understand this piece. I can talk to Joe. I can talk to Craig. I can talk to all the money mentors. But sometimes you just want to hear it yourself or research it and see it. So you can do that. We built the same thing in for Christy Van. So if you know about Christy Van and velocity banking, you can come in here and say, well, is it better to use my full line of credit or to use chunking? And Christy's got some strategies on that. And you can test that math inside of the vault. So I showed you a strategy where we were chunking out of the all-in-one, but I could just take the full amount and pay my debts off, and you could see what the differences are in the math. So those are some things we're doing. If you were to take us up on that offer, currently support loading One America Lafayette, New York Life, Guardian, Mass Mutual, Penn, Security, and Emeritus. And that'll allow you to upload your policies. Well, what does that mean? Well, if you upload a policy, we're going to give you that cash value breakdown of how does your illustration show me the cash on cash returns? When do I see my cumulative returns? What is my cash value growth? I can save it, I can print it. But we're also allowing you to kind of keep a repository of your policies in here. So this is actually the policy doc. This is the illustration. So if you ever had the need to go back into your original illustration, it's all here. It's all cataloged. And think about family plans where you've got multiple illustrations, you've got multiple insured folks. I mean, we'll have it all listed here so you can just kind of use it as a complete banking system. Now, what we're doing with some of the other pieces of this is I showed you the debt blaster, showed you the AI. Imagine you wanted to do a loan from your policy to maybe a family member, maybe your daughter. So you can come in here and kind of craft out how you want this to work. So let's say you've got a policy and it's at 5.5%, and you're going to do this for a car loan for a family member. You might want to structure your policy payments back at a 60 payments. So it's going to tell you, well, you're going to need to pay your policy back $191.01 in order to pay it back in 60 months. A lot of people say, well, why would I do that? I can probably find a better loan at 5.5. What this is showing you is the interest arbitrage. And this is only paying the policy back over the 5 years. Your effective interest rate is actually 2.71%, not 5.5. So this is where we kind of get into some of the simple interest and how the policy loans work. Well, it's right here for you. It tells you exactly what your rate's going to be. But what
Which
we
I
want
think
to
is
do with
super
that,
important because it gives people the math. It shows them the economic value of actually being an honest banker and actually doing what it always surprises me. People take loans from the policies, they pay off debts, but then they forget to recapture it. And then that's where they're paying, if it was 5.5% interest for the policy loan, you're paying that. But if you just are an honest banker and you recapture, which the system, we're not going to get into all that today, but the system will basically drive that through algorithms and through AI. But if you do it, it's 2.71%. I mean, who wouldn't want to save that much? I mean, you can't go to a bank almost ever and get a loan for 2.71, but that's exactly how the math plays out for your banking system. You're in control.
so let's say that you are the dad, and I've done this myself. I take a policy out, I take a loan for my policy and I loan it to my daughter for a car loan. And maybe we structure that at a 60-month payback as well. So what it's going to tell me is that my daughter would need to pay me $233.33 over that 5-year period. But now what's happened is because I've actually got this interest arbitrage going on, I've actually made $2,642.66 off of that loan. That's what we kept as a family by my daughter borrowing money from me for the car. That someday she's going to benefit from anyway. So why wouldn't she want to pay our system back versus the local bank? And then from there, you can hit generate promissory note and it will show you something like this. And Chris, can you see the note on your screen?
Yep.
This is a sample. And, as it says up here, there's disclaimers, but if you wanted to have the promissory note built, it's got the 10,000 principal, interest rate 8%. We're from Happyville, Kansas, let's say, and came from the bank of Daddy Doe, and it's being sent to Minnie Doe. So here's all the obligations. If she's late, there's payments, there's penalties. The whole thing's right here. But that's all the stuff we're building. Now, I'll just tell you what's coming up in the future. For some of you that may have seen the gain projector, the major purchase tool, we're building all of that in here. And that's why Chris says it's going to be October, later part of this year before we kind of round out some of these other pieces. But we've been focused on loan management and debts, velocity banking, and next it's coming investments and major purchases. And we've got a lot of other cool things planned, but this thing is really going to be that one-stop shop for you to be able to utilize velocity banking in ways that maybe you haven't even thought about.
And another couple things, Craig, can I show my screen? Because some folks
Sure.
are trying to use mobile. Mobile's a bit wonky right now, and it will be fixed by the end of this month.
Yep.
Like if you're on mobile, you got to turn your phone sideways, and when you go to click get started, it might just be a white screen. We're a little ahead, which is why we're discounting this, folks. I want to be very clear. Like, it's normally $39 a month. We're giving it to you for 19. There's a couple little bugs, but I promise you, like the beauty is, and us giving this to you for a discount, on mobile, we'll have that fixed by this week. There will be other things that maybe you find that we're not finding that you'll notify us, because there's a support tab. You click that and you tell us, hey, this isn't working. This is a way for us to expedite and get this thing really working. But I want to show you, because a lot of people are asking different questions, but you just go to BYOB, the vault, you click get started. There's different plans, and you can do bill yearly or monthly. Okay, $19 a month for the Debt Blaster. That does not include the things that we were just showing. So with the Debt Blaster plan at $19 a month, which is the same price you can get the policy plan, that does not include the IBC stuff. Then when you come down, this is the plan that we're offering the discount on, the policy plan. It's got everything that you wanted. You can do one policy in there. It's $39, but we're discounting this down to $19. So let's just say you click on that, you put your info in. Okay, I'll just throw my stuff here. I guess everybody's going to see how old I am.
Hey, Chris, just to clarify why you're inputting that, if you scroll down the page, the reason why people are confused over the price is because it's showing the annual price as default. So it's showing as 32 instead of 39.
I see what they were doing. So here, when you get here, you just want to use discount code, and it's the early bird. I've been seeding that the entire day. Once you apply that, it will drop your price down. Okay, to $19 a month, like you see there. So basically half, pretty much half off. So then you would just enter the information, the card, Google Pay, or however you want to do it. And that's how it works. So now let's go back and do it. And where people are getting confused, they're on billed yearly, or they're just looking at the main plan. Like they're probably right here.
Well, if you scroll down,
Scrolling down, you're looking here. This is
33.
because it's marked annual. If you go to monthly, it'll make more sense. Because if you pay by the year, obviously it's cheaper because we don't have to bill every single month. So we give a discount. And you can do that too. If you did it, one of these where you click get started. I was just trying to show you the quick way into it. So that's all you do. This is, go over here so it's not confusing. This is the plan you can get for 19. And again, the Debt Blaster plan does not include a bunch of the stuff that Craig showed you. It does not include any of that. It literally just gives you the Debt Blaster. So we're going to be offering the Debt Blaster for, a lot of people that just want to get out of debt. Maybe they don't want to do IBC. They don't want to do velocity banking. They just want the best way to get out of debt, and they want the schedules. That's what this is for. This is not what you folks want. You folks want this plan here for the same price of $19 a month. And hey, listen, if you pay annually, you get a discount. Even more off. So just trying to clarify that. Thank you, Stephen. And also too, I posted up there a second ago, a lot of you earlier, we've been posting this the whole day. We're asking, hey, I want to schedule a call with CMG, with Harrison, with Greg. We put that up there, but I'll put it again. Here's the link to schedule a call with them, and also a link to schedule a call with our team or Joe to get started with IBC and doing that. So we've got lots of options for you. The Vault is the software. The call gets you, on the phone with Harrison's team and Greg or Joe. Okay, so then you can get started. Hopefully that clarifies things. Did I miss anything there, Harrison, Greg, Joe, or Craig?
No, this is awesome. I'm super excited about this thing. This thing looks amazing.
And this is just the beginning.
I
Like
know.
we ran out of time, but there's so much more. And when folks get in there, here's the one thing that's going to be nice is, all the early birds that get into this thing, you're literally going to be taught how to use this at levels that no one else will, because we're going to be using the Vault for every single webinar and almost every single YouTube video that I do from here on out, because this is next level and what changes the game. And this is definitely what puts the power in all of your hands, because before this was all mathematically, right? You had to do all the math, or we had to do it for you. Now you're in control of it. The system drives, you're basically going in, you put the coordinates in, and the system drives you there. You just got to follow it. Listen, in your car, if GPS tells you to make a right and you turn left, guess what happens? You get lost or redirected. The software is no different. You might make a left when you should have went right. The software is going to recorrect you. If you keep going left, listen, you know, I'll give you a sign that says I'm with stupid. I don't know what else to say. Like, just follow the instructions the software gives you, and it mathematically gets you to your destination the most efficient way, like you saw. And I want to hit one more question that came up. Ogden said, well done, Chris. The tool is capable and timely, but the Iron Bank still directs the laws through its jaded Muppets. The system is monetized or monitored 24/7, can pivot equally or instantly. Compressing time will require not just AI, but factors outside of their framework. Otherwise, you're still playing on their field. So I didn't want to get into this, KI, but actually I'm going to. What you're probably referring to is blockchain, is digital, is, you know, DAOs, is off of the grid, right? Like things that aren't in their control. That's coming. I just can't tell you about it yet, but just know that the vault is moving that direction. And in the future, IBC, the vault, everything you just saw will exist in that world that is not controlled by the Muppets, or whatever you said, the jaded Muppets, I think you called them. So I don't know if that's more what you're leading to, but believe me, we're way ahead of that. We've got the team already engaged and working on that. You're just a little ahead of the curve on that. So first, we got to do everything in the real world, in the Muppets land. But we're going to play with the Muppets on their turf, but we're going to play their game, okay? And we're going to use it against them. And then eventually we're going to take the game to our own field where they don't control any of it. So just trying to get ahead of that and let everybody know that's a little bit too much for most of the people. But for you, K.I. Ogden, just so you know, that's coming and already in the works. It's not something we're thinking about. It's already in motion. It just takes some time. So, all right. With that being said, I don't know if there's anything else, Harrison or Greg, that you guys want to say to close this thing down?
Fired up. Really appreciate the opportunity to be here, guys. Obviously, I think that this vault system here is amazing. Going to sign up for this. I got the link pulled up right now. It is truly awesome. The integration with all of the trifecta and the debt blaster, it is truly kind of remarkable that you guys have put together something so numerically on the back end different. Craig, I'm not sure if you coded this or not, but I think you should start looking into rigging the lottery at this point, because I think you could figure it out. So I think that this was really, really amazing. I really appreciate the opportunity again. Thank you, guys.
Absolutely. Thank you.
Yep.
All right. Well, with that being said, thanks for joining us, and thanks for letting us go a little over for this wealth webinar. I hope you enjoyed it. We'll see a bunch of you in the vault. And with that being said, I'm going to bring this to a close. Go out there and take back control of your money, folks, because like I said in the beginning, the bank always wins. However, you can change the rules so that you win the game. And that's what we're doing right here, right now, in real time. Thanks. We'll see you next time.